When we think about growth, what usually comes to mind? Bigger is better, right? More is more. But what if the most important systems, like, say, the human brain or even financial markets, what if they mature not by getting bigger, but by getting smarter? For years, the story of the Indian market was all about size, all about volume. But just under the surface, something else has been happening, a quiet, fundamental shift towards precision. It's a lot like how our own brains develop. Think about it. The prefrontal cortex, the part that handles our judgment, it doesn't just get bigger as we get into our 20s. Nope. Instead, it gets way more efficient. It starts pruning away all the useless connections and strengthening the really vital ones. It literally cuts out the noise. And right now, the Indian capital market is going through its own prefrontal moment, a quiet rewiring that is changing absolutely everything. All right, so here's the game plan for breaking this all down. First, we're going to stick with our brain analogy to really get the big picture. Then we'll uncover this kind of invisible layer that's making it all work. We'll meet a key player who really embodies this shift, get how their business is built on trust, see the massive wave they're about to ride, and finally, we'll ask, is there a huge opportunity hiding here in plain sight? Okay, so let's really dig into this idea. I want you to picture a young market. It's just like a young brain, right? It's full of this chaotic energy, just too many connections firing all at once. There's a lot of noise, a ton of activity, but not a whole lot of precision. So maturity, then, it isn't about doing more. It's about doing the right things way, way better. And this really just nails the shift we're talking about. For the longest time, the Indian markets report card was all about trading volumes, just get bigger, bigger, bigger. But now, the focus is shifting to something way more subtle, the quality of intermediation. And look, that's just a fancy way of saying how well we connect good companies with the right kind of capital. It's about the quality of the connections, not just the sheer number of them. So, who is it that actually operates in this newly refined, more precise market? Well, this brings us to what you could almost call an invisible third layer. And in the world of capital markets, that is the merchant banker. Now, they've always been around, of course, but as the market matures, their role is shifting from some backstage technician to a lead actor, right out in the spotlight. Let me give you a super simple analogy. Using a credit card. There are two main parties, right? There's you and there's the merchant. But the only reason it all works so smoothly is because of that third party, the network like Visa or MasterCard, that sits right in the middle, making sure there's trust. Well, merchant bankers play a very, very similar role in the world of finance. At its core, a merchant banker's job is to manage this natural tension. See, on one side, you've got a company that wants the highest possible price for its shares. And on the other, you've got investors who want the lowest possible price so they can get the best returns. The banker's job, it's to find that perfect middle ground, that Goldilocks price that makes everyone happy. And believe me, the stakes for getting this balance right are absolutely massive. Just listen to this quote from Paytm's founder after their pretty tough IPO. He said, "To enter the temple of God, you need the right priest. Perhaps we didn't choose the right one." Wow. That just shows you choosing your banker isn't just another business decision. It can literally make or break a company's debut on the public stage. Now, this whole field was once dominated by absolute legends, figures like Uday Kotak. But now, a new face is emerging, Dharmesh Anil Mehta, or just DAM. And he's no rookie, not at all. He's an industry veteran who's now making a huge shift from being a top operator to a business owner. I mean, Dam's resume is just packed with experience. He cut his teeth building the institutional business at the legendary firm Enam. Then he took Axis Capital and led it right to the top of the IPO league tables. But then he made a career-defining move. In 2018, he led a management buyout of IDFC Securities and started the long process of transforming it into the firm we know today, Dam Capital. And this idea of a management buyout, it is so key, because when an expert operator becomes the owner, the whole dynamic just shifts. Suddenly, every decision is personal. Your reputation is on the line with every single deal. You're not just managing a business anymore. You're building a legacy, and you're putting your own name right on the door. So what does a business like this actually look like on the inside? Well, it's what you'd call asset light, but relationship heavy. I mean, there are no factories, no massive warehouses full of inventory. The real assets here are the team's judgment, their network of contacts, and a reputation that takes decades to build and can be destroyed in minutes. The company is really built on two pillars that feed each other:
It's a beautiful system. On one hand, you've got investment banking. That's the main engine, right? It brings in the big fees from deals like IPOs. But that engine is fueled by the second pillar, institutional equities. This is the research and the sales team that has these incredibly deep relationships with investors. The intel they gather from the market helps the bankers close deals, and then the deals give them something valuable to talk to their investors about. They work hand in hand. It's a perfect loop.
Now, Dame Capital isn't just growing in a vacuum. It is perfectly positioned to ride this massive wave of change happening in the Indian capital markets. There are some seriously powerful tailwinds that are creating an opportunity that we just haven't seen before.
So let's break down these tailwinds. First, you've got millions of new everyday investors flooding into the market through demat accounts and SIPs. This just unleashes a torrent of new capital. Second, India's own mutual funds are now so powerful they can anchor huge IPOs all by themselves, meaning we're less reliant on foreign money. And finally, all of this is happening just as the Indian economy is booming, which means more and more great companies need to raise money to grow. It's like the perfect storm for a business that connects companies to capital.
So, just how big is this opportunity we're talking about? Well, some estimates suggest there's a pipeline of roughly $150 billion worth of IPOs just on the horizon. And we're talking about household names here, like Geo, the National Stock Exchange itself, and Swiggy. The amount of capital that needs to find a home, it is just staggering. And here's where the business model gets really, really interesting. It's a concept called operating leverage. Think of it like this. You're putting on a rock concert. The cost to rent the stadium and pay the band, that's fixed. But once you've sold enough tickets to cover those costs, almost every single extra ticket you sell is pure profit. It's the same idea here. D&M's costs, like salaries, are pretty stable. So when the market heats up and all that deal revenue starts pouring in, profits can absolutely explode. It creates just massive potential in the good times. So all of this leads us to the big question, right? Given everything we've just talked about, could a business like Dam Capital, which is publicly listed, be a seriously overlooked opportunity? Let's see what some simple math might suggest. Look, this is a tough business to predict. It's irregular, it's lumpy, it's hard to read from one quarter to the next. But if we zoom out and we think in terms of market cycles, a much simpler picture starts to emerge. So what does the math say? Okay, here's the back of the envelope math from the source analysis. The company today is valued at around 1,000 crore rupees. Now, if the market cycle turns in their favor, the belief is this business could potentially generate 200 crores in profit per year by 2029. And what that means is you're looking at an implied forward PE ratio of just 5. Now, for context, a multiple of 5 is what investors usually pay for really slow growth or super high-risk businesses, not for a potential leader in a market that's about to boom. And this is a huge but. You have to remember the nature of this beast. It is a cyclical business. It feasts in bull markets and it starves in bear markets. The path to those potential profits is a roller coaster, okay? It is not a straight line. And it all depends on the health of the broader market, which, as we all know, nobody can predict. And so we come full circle, right back to the brain. Maturity, it doesn't happen overnight. It's the result of years and years of invisible refinement. And the same is true for India's capital markets. The role of the intermediary, the market's architect, has been quietly strengthening for years. And now, this once invisible layer is finally stepping out into the spotlight. So the real question is, as India's market truly comes of age, who are the ones that are going to build its future?